October 25th, 2023. Today we got a measured move down of the opening spike, and that's about where the low of the day was, right here. Generally, when you get a big gap and then a big gap down in a strong bear trend bar, it increases the chances that you're going to get a bear trend day today. Same way that if you get a big gap up in a big bull trend bar, it increases the chances you're going to get a big bull trend on that day. I have a couple of examples of measured moves of opening spikes. You can see we got this opening spike here, and we got a measured move down of it. The measured move can be in either direction. We got a spike up here, we got a measured move up, spike here, and then a measured move down. This was today. And then you see we got a big spike here and a measured move down. So when you get big spikes on the open, pay a lot of attention to them because a lot of times they're going to lead to measured moves. And additionally, this is all one big trading range, right? So if you look out over the past, couple days since this bear trend started, we had a bear trend and now we're in a trading range. And when you're in a trading range, you expect the market to test the lows of the trading range. And you can see, and you expect trap traders to be able to get out. You can see the high of 940, or be bar 3 on Monday, was 4,222.5. And that's essentially what I personally thought we were trying to test after we got bar 1. We got some follow through on bar 2, but the problem is there's a big tail on the bottom. So sometimes you get one down, up, and then second leg trap. So the problem with 3 is it could be a second leg trap, but ultimately it's a sell to close market. It's a bear trend. We're probably going lower, and there's room to make more than 10 points to that low. So I think it's pretty reasonable to take the sell below 3 and look for a swing. We got good follow through on bar 4 as well. You know, it's still okay to sell, but you're starting to get closer to the moving average, or sorry, to the magnet. So less traders are becoming interested. And then we get bar 5, which is basically profit taking. Bulls who sold anywhere in here are starting to take some off because they know that there's not much left to the magnet. Sometimes you just get vacuumed down to the magnet. I kind of thought that was going to happen. I was actually pretty surprised we didn't end up touching it here, but it made me think that this rally was going to end up leading to a second leg down because this was strong enough to get a second leg down. So I thought this was a pullback and we were going to get the second leg and test it. And you can see that's exactly what bar 33 was testing. It's testing that that high from the other day. So that's why we found support there. And it's got a two-legged correction, but I'm getting ahead of myself. So disappointment on bar 5, and some bears, who sold up here or maybe this close, have a decent profit, and they'll just exit at the market after bar 5, after the first bull bar. And that's what causes 6. I don't think that bears have to exit above 6, but some would if it triggered. And so what bears are doing is they're aggressively selling the open of the bar, trying not to let that bar 6 trigger. Additionally, some bears are selling because they still think we're going to get to this magnet, and this just gives them a better price to sell at. So bears will sell above 6 if it triggered above, and they'll sell to close of 6, thinking that if we start to rally, then they can just get out. But more likely, we're going down here. So that's why you get a big bear surprise on bar 7. Bar 7 doesn't close quite as strong as you want it to, and bar 6 closed a lot stronger than you want it to as a bear. So you have to be thinking that maybe this is, it's obviously not going to do this all day. So you have to be wondering, when is this probably going to come to an end? I personally thought we were going to get to this magnet first, but we never did, or we didn't there. So bad follow through on 8, and as a bear, I think you have to exit above 8. It's a second reversal. 7 could be a second leg trap. I'm not saying you should buy above 8, but I think bears should definitely be getting out above 8. And then you get outside down on 9. Now, why don't bears sell below 8 as it goes outside down, trying to test that magnet? There's still a couple points of a scalp left essentially on the trade. The reason they don't is the equation isn't very good. You have to have a stop at least up here to sell below here. And most of the time, the traders who are taking that trade, they're going to scale in and then try and exit around break even. You can see it's exactly what they did on 12. So you get 9, and it's obviously disappointing to bulls. There weren't any buyers here. But, bulls are going to start buying below, betting that even if we get to the magnet, they're going to be able to buy more there and be able to make money. Any bull who did buy 8, obviously disappointed in 9. They're scalping out around break even, around the close of the bar during 10, and others are getting out around the high during 11. So you can see any bulls who bought here for any reason are disappointed in this and they're getting out. And then we get another leg down on 12, and 12 goes down and tests the 9 low. And so any bears who sold as this was going outside down, hoping to make a scalp, got trapped. When they got trapped, they used 12 to get out at break even, rather than continuing to sell and hoping we get down there. Reality is it's 1, 2, 3. So 1, 2, 3, 4, even with 12. So it's some sort of wedge, and this is a tight trading range. And tight trading ranges, deep in both bear trends, a lot of times end up being final flags. So that's kind of what we got. And bears start to give up on 13. You can see any bears who were holding short are disappointed that 12 didn't reach the magnet, and the market's now failed twice to try and touch this magnet. So it is a double bottom, and they start to give up on 13. And even the most, diehard bears are going to give up once you see 13, because they think, well, now these limit order bulls who bought below 6 have made money. We're probably at least going to get here. We might even have to get here to let the limit order bulls who bought below here make money. And so those bears just start to give up at the market, and that's what's going to cause the bounce on 14. And we get back to that low. And 15, I think it's just a lack of buyers. I don't think it's aggressive selling on the bears' part. I think bulls, they were buying, bears are buying back shorts. That's causing 14. I don't think there's as many bulls buying. So that's why, when you get a disappointing tail, and you're going to get bad follow through. And the disappointing tail, it keeps more buyers out. If this bar closes on its high, it's more likely that bulls are going to buy for a swing. 16 is a second leg up. 13 and 14 is strong enough for its own second leg up. So after bad follow through on 15, we get another leg up on 16. And then you get bar 17. Things to keep in mind: 90% chance we're breaking out of the 18 bar range. The move from 1 to 12 is strong enough to get its own second leg. I've been looking at lately, I think the 90% chance that we break out of the 18 bar range statistic is very helpful. And I've been looking at the 36 bar range recently. I've only gone over the past 20 days or so. I'm going to go over, I'm probably going to have to go over at least a year of data to get an accurate analysis of it, but I'll do it at some point. But over the past 15 to 20 days that I've looked at, there's still almost a 90% chance that we break out of the 36 bar range. But I need to do more analysis on that in order to be sure. But just goes to show, it might be okay to sell below 17. I'm not positive. You're selling the bottom of a tight trading range. So I get the argument that this is pretty strong in a pretty tight bull channel, and you're kind of selling in the middle of an overall trading range, and you're selling in a tight trading range. So the bear argument is that we should get a second leg down and break out to the downside of the opening range. If we're going to do that, 18 is probably going to be bigger follow through. And when you get the disappointing follow through on 18, look closely at where the bottom of 19 was. Traders sell below 17. Their entry price is, so it's the low of this bar is 4235.5. So that means their entry price is 4235.25. And that's exactly where this low went to. And so basically we get to here, and bears are buying back shorts aggressively, and that causes this big bounce. Something else that's really, really interesting is that the open of the day ended up being the high tick of the day. This happens about once a year. And Al actually points out in his book a lot, and I was rereading the other day, that all the data that we're seeing is sampled data. So, you're not seeing every single tick. So sometimes, there will be a slight tick up on bar 1, and there'll be there'll be a small tail here on the actual chart, but this is all sample data, so we don't see it. So the way you can tell what the actual chart looks like is you go onto the CME website, and you can just go to CME futures. I just Google CME futures, and you can see today, though, the high of this bar, the high of bar 1, was exactly where the open was, and that remained the high of the day. So that only happens about once a year, maybe twice a year. So I thought that was pretty cool, but it's not really very useful for trading purposes. But I just, maybe you could argue that we should go above it, most of the time, because that's really rare to happen. But in general, I think it's more useful to use, though, we're going to break out of the 18 bar range. So that's a stronger argument that we're going to that high, in my opinion. But I just think that's cool. So I was on 19. Bears buying back shorts is what's causing 19. So it's not surprising it doesn't get follow through. Then you get 20, it's doji bar. The bull channel is pretty tight, but the bears still should get a second leg down. And it is 3 pushes up to the upper part of a trading range. So I think it's reasonable to think that selling below 20 might be okay, or you might have to wait for a little more follow through. Usually if you're going to take a trade like 20, it's low probability. You recognize you're taking a 40% trade. It's probably not going to work. And so when you're taking a trade that's probably not going to work, a lot of times you want really fast follow through, and you really just don't get it on 21. But I don't think 21 is a great buy either. You're buying towards the top of a trading range, and you're trying to get a breakout above a bull flag. But in reality, you're just kind of buying a fourth push up. If you're buying above here, 1, 2, 3, 4, and these are all pretty climactic moves with big tails on the top. And this was a lot stronger than this. So I don't think 21 is a very good buy. That's why a lot of traders didn't take it. Trading ranges will try to trap you out. So they'll, traders sell below here, disappointed in this. Some of them will exit above here, but that's not a very smart thing to do because trading ranges are constantly trying to trap you in and out. And you can see the bulls, any bulls who do buy above 21 immediately disappointed in 22, and they're immediately panicking out of longs as close to break even as possible. And that's causing the big dump on 23. So, you get 24, it's a good bull bar and potentially some sort of double bottom, but it can't quite close on its high. So not as much you can do with that. And then bears get big follow through bar or big bear bar on 25, which is important. Now, it's obvious that, when you get a big bar like this, like I mentioned, it's probably bulls selling at longs from up here. That's what causes these vacuums a lot is, this is when you get this big bull bar in a trading range, it's just bears covering shorts here. And you get this big bull bar, you can see it was bears getting out around break even and covering their shorts. You get this big bear bar, it's bulls being disappointed in this and causing that. So you really need to look at the context of these bars and find out, like, is this the kind of bar that's going to end up going super far? Probably not, because it's bears buying back shorts. It's not as many bulls buying. So anyways, 25, the problem is you're right at the 23 close. Sorry, the 23 close. So some bears will be buying back shorts. So that's what's happening here on this low, why there's a tail. And that's why, when we initially trade below 23, back below 23, there's initially buying there causing 26 because bears got trapped on 24. 27, it's a bear bar. It's some sort of attempt at a bull flag. Bulls are trying to get some sort of wedge. Probably not going to get it. And then you get 28, and I think 28 is an okay sell. I think it has a bit better probability than 20, but you're paying a higher price for the better probability, and you're hoping for a breakout below the bull flag. So you're hoping you get a measure move down to somewhere down here. You're risking 7.5 points. And there's a pretty good chance you're going to get at least a 1-to-1, maybe a little bit better. So risking 7 points to make 18, probably 45, 50% trade. It's a good equation. Kind of bad follow through on 29. And then you get a big bar on 30. It is a breakout, like I said, below the flag. The pullback on 29 is concerning. It could be some sort of, parabolic wedge trap because you can see we're trying to break out of the bottom of a trading range or at the bottom of a channel, but it's really just turning into a triangle. And as a side note, that was, a triangle was essentially what was happening at the end of the day too. I thought the end of the day, I thought the end of the day had some pretty interesting things as well. 31, more follow through. At this point, especially once you see 30, most traders know that we're getting below this low and we're probably going to get to that 3 high from Monday, which I mentioned was like right here. And so, sometimes bulls will step aside and you'll just get a quick vacuum test down. Didn't really happen here. We still kind of drifted down, but you can see we got the breakout of the 18 bar range and a lot of traders took profits because we got that breakout, and that's the magnet those traders were looking for. We got that breakout down to that 3 high, and the traders on 33 who were looking for that magnet instead of this low, they took profits, and that's causing the bounce on 33. Inside bar on 34, you're in 1, 2, 3, 4, 5, 6, 7, 8. So an 8 bear bar, 8 straight bear bars, bear micro channel for 7 of 8 bars. So it's an inside bar, but I think it's probably a final flag. We're probably going to pull back here pretty soon, especially with all these tails on the bottom. This could be some sort of parabolic wedge, or you could say spike channel. So I don't really think it's all that good to be shorting down here. I think that you're also selling the bottom of what's probably going to form some sort of trading range. So you have to be careful with that. A lot of traders might exit. If you flattened in here, you get a 2-legged correction, and bears or stop order bears, always in bears, would sell again below here. You get bad follow through on 34, low 1 short on 35. Some bears might sell low on short on 36. This, I think 35 is mostly profit taking, and there's a lack of bulls willing to buy up here because of how strong this is. Some bears might sell below 36, and if you do sell below 36, something really important happens on 37. You get trapped. So bears who sell below 36 are trapped out on 37. If you're trapped out on 37 and then you get a bar like 38, you now have a ton of bears who are trapped out, and now there's a big bear bar going in their direction. What's going to happen? A bunch of bears are going to be selling below that bar. So bears are selling, and that's what's causing this big bar right here. And we end up getting a 1 pullback 2, so 2 legs. But I think the reason why we got this big tail, there's a couple reasons. It could be a third leg, 1, 2, 3. Could just be, you could argue it's just a second leg trap. But if you're low in what's a possible trading range, and you get a quick 5 points, a lot of traders just take it. And that's what causes the bounce on 39. Bear bar closing near its low on 40. It's okay to sell below this low. It's okay to sell below here. I also, if you bought below 30, 37, so let's say you're a bull, right? So your thesis is this is the bottom of a trading range, and we're going to end up getting a bounce because there's a lot of trading range price action and a lot of good bull bars. So we're probably going to stay within this trading range. If you bought below 37, you get filled like right at the low of 38. You're really not thrilled with how strong 38 looked. And so you might get some bears covering shorts, and or some bulls covering some bulls selling at a longs, and that's causing 39. So a couple different reasons to be short there. Bad follow through on 41. Traders not selling 40 as much, concerned that it's a 1 pullback 2. It's also just in general the bottom of the bear channel, right? So it's pretty easy to draw the bear channel at this point, and you're somewhat near it during 41. 42, more bad follow through, and you get a big outside down bar on 43. I don't think 43 is all that great of a sell. You're very close to the bottom of that bear channel, and you can see it never ends up triggering, and you get a bull reversal bar on 44. You could, this is an OO pattern, so it's an outside pattern. So you get 41 and 42, tight trading range, OO, so outside. So we're probably going to end up testing, the apex of the outside bar. The same way that inside patterns are triangles, outside patterns are expanding triangles, right? So an expanding triangle does this, and an OO pattern does the same thing. So an OO is just an expanding triangle on a lower time frame, and an II is just a normal triangle on a higher time frame. So like here, let's see if we can. So this is a triangle, right? You can see it's a triangle from 150 to 210. So let's go to like a, 25 minute chart. Maybe it'll demonstrate my point. Not quite. It's close. There is some time frame. I'm not going to bother scrolling through all of them, but you can see what I'm saying. It's almost formed an II. I'm sure there's some time frame. Maybe it's the 20 minute, maybe it's the 18 minute, whatever it is. But you can understand the point that I'm trying to make with this. It doesn't matter really what time frame it is, but it's important to understand the concept that this is an outside. I think bears are going to exit above 44. It's a good bull bar, and with how overdone we are in general, the lower we get in a bear trend, the less tolerance bears have for pullbacks. So I think a lot of bears will exit above 44, and that's causing some follow through on 45. You can see any bear who sold the close of 43, disappointed in 44 and 45, and they're getting out during 46. So we start to go down here, they'll buy back shorts. And bulls will buy below 45, knowing they're able to scale in and make money. But bulls disappointed at 46, not a bull close. And then you get down up on 47, kind of a similar situation. Bears buying back shorts once we get down here. But we get a bear body. So any bulls who are buying, very disappointed in 47, and they're all going to sell to their longs, and that causes a big bear bar on 48. If you're an always in bear, you can sell again below 48. I think the important always in sells today were 38, 48, 60. And maybe 28 or 30. But I think those were the important sells for the bears today. Pullbacks, general, and a bear channel. Follow through on 49, inside bar on 50, but big tails on 48 and 49. Not ideal. 51, more follow through for the bears, and same thing with 52. Again, it's a strong bear move, but we're really, really overdone in this bear trend. So a lot of traders might pretty much be willing to exit above any bar. And when you get 53, a lot of bears, pretty much any bear that sold any close except for 52 is now at, or maybe I guess 51 is roughly at a profit on 53. And when they have a profit and you're this deep in the bear trend, you're around that measured move down. There's just a lot of support here. So a lot of traders will just exit above. And that's what's causing all the strong follow through on 54. I don't really think it's much bulls buying above 53. I think bears exiting is causing the bull bar on 54. Disappointment 55, 56, and a second leg up 57. So 53 and 54 are good for the bulls and good enough for a second leg up. Additionally, 55 is a low one short. And bad follow through on 56. So if you sold below this, you're already pretty wary of this bear trend because how long it's been going on, and you get the two strongest bull bars you've had in the bear trend so far. So bears are pretty wary about selling below 55. And when they get bad follow through on 56, they're going to be exiting out of their shorts pretty quickly, and they'll be buying them back, and that's causing the rally on 57. Additionally, we touched the 53 high, which is an area where bears are going to sell. Bears will sell above, betting that this is strong enough to get a second leg, and this reversal up is going to fail. And so we're testing that, letting those bears out, and that's the rally on 57. And this is bears buying back shorts, so that's why there's disappointing follow through on 58 and 59. And we're also touching this low. So if you bought below this low, you're disappointed in this. Those traders are getting out. That's causing all the selling. Bear bar closing near its low on 60. I think it's a reasonable sell below 60. It's a two-legged pullback, so I think as an always in bear, you can take the short. But again, we're really deep in this bear trend, and something interesting happened. We broke the trend line, right? So this is a big bear trend, and we broke the trend line, and we might be trying to set up some sort of major trend reversal and a potential buy the close finish because, a decent bull move early in the day. So it's possible that we're going to end up getting some sort of trading range day, and limit order bulls started making money. And I thought that the 37 low was a spot where limit order bulls most likely are still trapped. You could argue they got out on the 39. You can see a lot of them got out, but I think there's potentially still a lot of them trapped. So I was looking to buy above in here for a swing up. I'll explain what I did in a minute, but once we get there. 61, you can see it pulls back to the 59 low. Bulls who bought below 59, disappointed 60, getting out. You got follow through 62, 63, 64, but these are all small bars. To me, this looks like a bear channel. Like, 60 to 64 probably looks a little weaker than this on a smaller time frame, like a weaker bear channel. And I think we're really just trying to test the 52 close to let these bears out. You can see we got close, and then bears bought back shorts, and we got a big bull bar closing very strong on 65, but it didn't quite close on its high. The context for a reversal I thought was really good because of the trend line break that I mentioned, but disappointment on with how strong 65 closed is going to cause something like 66. And when you're taking a trade, when you're buying after 5 straight bear bars, you got to be pretty quick to get out. And so you get 65, disappointment, 66. You can see that high is exactly where those bulls, they bought here, disappointed this, they're exiting at break even. That's causing 67. 68, I think there's not a lot of bears willing to sell below 67 because 67 is mostly caused by the bulls selling it alongs here. 69 just looks like, probably not as many buyers above 68. Any bulls front running 68 are disappointed in the close and they're not willing to buy. And then you got 70. 70 didn't quite close on its high, but it got bulls, some bulls will buy the close hoping that we got exactly what we did get. And they're hoping to get in really early on what could be a really good swing trade. And I thought that 71 was a good buy. You got 1, pullback 2, so it's potentially a second leg trap at the top of the trading range. That's the bear argument. It's also not really a big breakout. If it broke out above 66, I think it's a better buy, but it's not as big of a bull bar as it could be. Some bulls will buy smaller and put buy stops above the breakout points, and they'll be looking to add on as we go higher. But 72 is a problem. 72 is disappointing for the bulls. If this is so bullish and we're probably about to race up, then why are we getting bad follow through on 72? Some bulls will hold, though, because they know that 70 and 71 is strong enough for another leg up. And, even though we get 72, we could still race up here. But I think 73 is really the big problem for the bulls. It went up, and then bulls scalped out with, I don't know if they made 5 points. What's this high? 14, so get to 1975. I don't think they did. Yeah, so bulls scalped out with less than 5 points, and that's causing this selling. And it's disappointing for the bulls, and it's making 73 look like a second leg trap. So that's why a lot, there's not much aggressive buying on 74. Bulls are disappointed. A lot of them are getting out. And then, the rest of the bulls are exiting below 74, and that's causing 75. And it's too late in the day to trade, but you can see even 76, if it had closed strong, some algorithms would have bought, hoping that we were going to start a rally that would have lasted into the night. And then we got a disappointing disappointing close on 76. So we don't end up getting that. For always in, I thought selling, you could sell one for a swing, but I try not to trade the first bar of the day. You could sell below 3 and hold. I don't think you have to exit above 6 if it trades above 6. And then this is potentially a second leg trap. I think always in bears get out above 8. And I don't think you want to sell as it goes outside down because it's potentially a third leg. And you're right at that support level. And the equation is bad. Always in for, I thought you could sell again. I might be wrong. And I might be biased because I did sell 17 today. But I thought that 17 was an okay, as long as you're quick to get out. If you can get out, break even really fast after the bad follow through. Or you can scale in higher. So I thought that was an okay sell. But I think these are all lower probability, and the always in is really confusing. I think it becomes pretty clearly always in short below 28 again, maybe definitely by 30. And you don't have to get out in here. You could probably like a couple points above the bar, or maybe, the measured move up of 434. I think it got run though. Yeah, even 33. That'll happen sometimes when you're getting a channel, is it'll run, the measured move stops. See, it ran it to the tick here. I've noticed that. So sometimes it'll run those stops and traps all sorts of traders out. And that's why, 37, they're 38, another good always in sell for the bears. I think you probably have to exit above 44 and maybe sell again on the close of 48. Exit above 53 or 54. Sell again below 60. Exit above 65. I don't think you have to sell again. And I think bulls can buy above probably 71 for a swing. But, quick disappointment. So, yeah, on the daily chart, we could continue down. It's obviously possible. But to me, this looks like 1, 2, 3. And, I think the bulls who buy below here are going to make money, moral of the story. So I don't know how much is left to this. We might get follow through. It's possible. But if we start to rally tomorrow, it'll be interesting to see what happens below today's low. If we get like a somewhat neutral gap, we'll see if there's sellers below that low. There probably won't be. But if we start to get a reversal up from yesterday's low, I think that'll be a pretty reasonable buy. Yeah. That's the day.